Hello everybody and welcome back. In this video I will show you all my mistakes, all my gains, the bad decisions from 2025. What happened during this year, what are the lessons I learned, and a little bit of updates, because after all I publish every day, right? So I give you some update at the end of the year to see if we performed well or not, and what did we do wrong during this year. This will be the topic of this video. I don't know how long this video will be, but I'm sure you will get a lot of value because literally I'm giving you everything here. So I have prepared some notes, some bullet points for you. 2025, my brutal investing mistakes, gains, and lessons. So, what was the goal for 2025? The goal for this year was to reduce the number of mistakes. That was also to sell the low quality companies in my portfolio following 2024. And it was also to only invest in superior companies that will benefit from inflation. I made a video 1 year ago saying how I will invest in 2025, and it was the pitch. It was the pitch. Increase the quality of the portfolio and only invest in companies that will benefit from this new inflationary world, okay? And always be careful, being mindful of the valuation. Only be investing in good companies, efficient companies that are shareholder friendly, okay? So I wanted to only invest in shareholder friendly, efficient companies available at a reasonable price. So let's see the kind of mistakes I made, the kind of gains I made, the kind of decisions I took during this year. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. So you can make 25% per year even if you make mistakes every year. And this is the goal of this YouTube channel also, is to show you how I'm doing it. So you can learn from experience, you can learn from other people, including myself, and you can become a better investor. So let's start with what was wrong during this year. Let's start with the mistakes. The mistake number one was selling Alibaba. I have not made a lot of videos about Alibaba, but I've been a shareholder of Alibaba since 2018. Okay, let me start this video by maybe the biggest mistake in terms of timing. I have been a shareholder of Alibaba between 2018 to beginning of 2025. Can you guess the moment the stock started to rebound? Exactly 1 week after I sold it. And I made a video about it. I sold Alibaba, I don't know, in January 2025. And just after I sold, the stock began to rise. I sold at $80 and the stock immediately doubled during the year I sold. So in terms of timing, this is a mistake because you never know what can happen in the stock market. But that's okay because life continues. And even after this big mistake, because after all, when I bought it was a sizable position and I held for years and years and years and years. And after this big mistake of commission, the stock rebounded easily. But despite this big mistake, my performance was still great because I moved the proceeds from Alibaba to other winning companies. And we will talk about this later. The point I want to make is, even if you make a mistake, a timing mistake, you sell something and something doubles, well, you can always sell something to buy something better. And spoiler alert, I bought something that doubled also in value. So first mistake, but also you see you have different piece of the equation. Because even after this big mistake, what is the performance, year-to-date performance? My portfolio has a performance of 21.2% year-to-date, while the S&P 500 has a performance of 16.4%. So that's what, an outperformance of 4.5%. So far, so good. So first mistake in terms of timing, I was monitoring the operations of Alibaba and I had been struggling for so many years. And bad timing, I wanted to start this video because it will happen to you eventually, okay? After holding since 2018 and doubling down, tripping down, doing nothing. The company was not good enough for me. So I decided to sell, and then immediately after this, the stock rebounded immensely. What will the future of Alibaba be? Well, it's still a value play. It's still cheap. And 1 year ago, almost all the cash was reallocated to do buybacks. Now it seems like buybacks are less important for the management team, and they want to ramp up capex to go into the AI race. Anyway, if I had not sold at $80, I would have sold in at $130, $140. So it's not the end of the world after all. Let's move on to the next mistake. The next mistake was not buying Games Workshop. Maybe you are not familiar with Games Workshop. It's a company in the UK. They sell miniature soldiers. They have the Warhammer license. It's a game. It's a plateau game with a strong community. And I understand this company very well. It's inside my circle of competence. And I mean, it has been on my watch list, but I have been greedy. I wanted a better price. Because as you can see, for the past 3 years, the stock has gone up, stabilized, gone up, stabilized, gone up. You don't have a lot of disappointments for the stock, and it has always been on my watch list. And I'm still eyeing a good price. A bad quarter or something company specific or a bad press release. And Games Workshop has been an immense inflation beneficiary, because they have immense pricing power. They are in a niche market. They have a monopoly. They can price whatever they want. They can double the price of their products. And still people are so in love with the brand that they will buy. And I understand this stickiness very well, but I'm stupid, so I did not buy. And the year-to-date performance has been plus 40%. So as a reminder, I understand this very well. I've been a gamer for more than 15 years now, so I understand the sense of community, belonging, pricing power, collection, crafting your own tools, and I am just monitoring the stock price, marching up, and all the press releases we had for Games Workshop were positive. Because guess what? Winners keep on winning. This is a winning company in a winning industry, and they keep on winning. Every time there is a press release for Games Workshop, it's to announce a good news. Because we will increase the guidance, or we will do better than expected, or we are increasing the dividends. Every time it's good news. Every time positive news. So you are talking about Games Workshop, a small company, market cap of $8 billion in the UK, gross margins of 70%, net margins of 30%. It could be a tech company, you know. The revenue is up and to the right, as you can see here in blue. The net income is going up and to the right, as you can see in green here. They don't have any debt problem. They are filled with cash. The free cash flow is going up and to the right, as you can see in blue. And they pay 50% of their free cash flow in dividends because they don't understand buybacks. Anyway, this is a company that is promising you have a dividend yield of 1 or 2%. And now the stock has gone up. So now the PE ratio is above 30. And I always wanted to buy Games Workshop, but I wanted to buy at a cheaper price. So I just monitor it and nothing ever happens. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. Look at this. You have the stock price and the PE ratio for Games Workshop. The PE ratio of this business has oscillated a lot. In COVID crash, it was like 15, and then it went up to 40, and then in 2022, it was to 15, and then 25, and then during 2024, it fluctuated around 2022. And for the majority of 2025, it has been oscillated between 22 and 27, and then 24, and now 32. We are at the highest valuation for the past 3 years for Games Workshop. And the stock price is just on a run. Stabilizing up, stabilizing up. So I could have bought this stock when everybody was freaking out in April 2025 when the P ratio was 22. But I decided to buy other things. And I will talk about this later. Anyway, maybe it would have been smart to buy this because you had some tariff fears at the time. Games Workshop is not impacted at all by tariffs. Meaning, they will be impacted, but they have such an immense pricing power, they don't care about tariffs. They can put any price they want. Okay? So yeah, pretty interesting, but now I cannot buy it. It's just too expensive right now. We will see how it goes for 2026. Games Workshop is inside my circle of competence. I understand very well it's a buy and hold. You have one of the most honest management teams I've ever seen. If you don't know this business and if you want to learn, just for the sake of learning how to pick stocks, please read what the management team has to say. This is crazy good, I would say. Very, very important. And the CEO is speaking to shareholders like he's managing their money, which is the case. For example, the kind of words they use, the kind of sentences they use, the kind of simple words they are using. And anybody can understand what the CEO is saying. You don't have complex words. You don't have complex formulas. He's explaining very well, as if he was talking to a child. And this is what Warren Buffett preaches for management teams. When you are a shareholder and you are reading a report, you want the CEO to explain to you in simple words what is happening. Games Workshop is maybe the best company that is doing this on earth. Or maybe my favorite one. If not my favorite, it's definitely in my top 3. That tells you a lot about what I think about their management team. I think they are great. Absolutely great. It's just that the valuation was a little bit too high, especially since it's a company from the UK. You could have bought a PE ratio of 30 if this was a US listed company. But that's the UK. It's a cheap market. So relatively to the market, PE ratio of 30, it's not cheap. But the business is fine. The business is fine and they are reaccelerating. So everything is going in the right direction. Next point. Okay. Holding Amazon is another mistake that I made this year. Well, it's partly a mistake because I decided mid-year that I only wanted to invest in efficient companies that are improving their margins over time. And I only want to be invested in companies that have a low capex. And at the beginning of the year, I had Amazon and I have been holding Amazon when I wanted to only invest in capex light businesses. So after the middle of 2025, I finally trimmed the position by 70% and I expect to sell 100% soon. Maybe in 1 month I will sell. So it's been a mistake to hold, especially since the stock has done nothing. The thesis is playing out. Amazon is reaccelerating. The business is fine. We'll automate everything with robots. But in terms of performance, if you look at the short term, year-to-date performance, plus 3%. So I sold at the top here at 250. So it was a pretty good arbitrage play. And maybe I'm waiting for a stock rebound so I can sell what is remaining. But so far it has been a mistake. If you just want to judge my 2025 performance, if I did sell Amazon before, I would have had a better performance because I have made some winning decisions during this year. Okay, first of all, selling Louisiana Pacific Corp, LPX. It was an investment inspired by Warren Buffett, and I think I sold almost at the top, around $100. And yep, it's been a buy and hold. Buy low, sell high. It's a company linked to the home building equipment industry in the US. And they had some great years back in the days. in 2020, 2021, 2022, and they used all their cash flows to do major buybacks. In 2021, look at this in green, the green candle. In 2021, they bought back 19% of their shares. In 2022, they bought back 16% of their shares. So I saw this, I saw the potential of this stock, and I bought, I think in 2023, had a very good run. And then when the stock became a little bit expensive, I sold. And so far, so good, because the stock has been down 30% since the all-time highs. So pretty good timing, and it's in line with my strategy of only holding high quality businesses that are not cyclical, that are asset light with minimal capex. Louisiana Pacific Corp has made some money for me, but it is not fitting this framework. Next one, selling pool. I made a video about Pool Corp at the beginning of 2025. I mean, you can check my channel. This is great. I mean, you have a track record of all my decisions because I made a video at the time, so you can see my reasoning and if I make sense. If I don't make sense, please comment on this video. But I think so far so good, because the narrative I had for Pool Corp turned out to be right. And I sold Pool Corp because I anticipated major tailwinds for this company. And I said, earnings are not rebounding fast enough. And now they have debt. And now they are competing with their partners. They have been collaborating with partners, and now they made an acquisition to compete with their friends, basically. I did not like this. I did not like the debt. I did not like the capital allocation decisions recently. And I did not like how it's not an inflation hedge. And I did not like how earnings are not rebounding, not fast enough. So since I bought in 2021, the revenue has been trending down. Now it's flat. The debt is still here. The cash flow is a little bit of a mess. And they do small buybacks here and there. But so far, it has not been a great turnaround play. And since I sold at the beginning of this year, I sold, I don't know what price I sold, but at the beginning, like January, February 2025, it's down 30% year to date. So I definitely dodged the bullet here. I dodged the bullet, and the stock is now down 60% from all-time highs. Yeah, it was a growth trap. Not a value trap, but a growth trap, because you expect the growth rate to continue. So you can pay a premium because it's a growth company. What if the growth rate collapses? The premium you pay is not warranted. What if instead of decelerating, the business decreases? The revenue decreases, the net income decreases, the free cash flow decreases. Well, this is exactly what has happened for this company. Look at this, the revenue down, net income down. So the PE ratio that was, 40 at the time, even if the stock got cut in half, the PE ratio doesn't go from 40 to 20 because the net income was cut in half. Look at this. The net income went from $750 million to $430 million. Almost got cut in half. So the valuation is still not cheap. You have a PE ratio of 20 after the stock price decreased by more than half. Okay? Because net income is going down. Free cash flow is going down. I'm monitoring all the quarters for Pool Corp. I'm happy to get back in if I see some signs of improvement, but so far, no. And I want to make another point, which is Warren Buffett and Berkshire Hathaway were buying Pool Corp when I was selling. And I remember at the time, you can check the comments below this video. People say, you don't understand. Warren Buffett is buying. Maybe this is stupid. Why do you sell when Warren Buffett is buying? It depends. First of all, it's not Warren Buffett. It's either Ted or Todd. And secondly, for Berkshire Hathaway, it was only a small amount of their portfolio. So they can make a mistake and it's okay. And this is just such a big conglomerate, it will not move the needle. For me, it was more than this. So I trimmed the position, trimmed, and sold. And it's okay. You don't need to agree with everybody here. You can make your own decisions. If you feel like buying Pool Corp, if you feel like selling Pool Corp. I'm making videos on this channel so that you have the tools to be better investors, right? So you can have an independent mind and you can make your own decisions. It's not because Warren Buffett is buying or somebody in his team is buying that you have to buy. You have the tools now. If you watch all my videos on a daily basis, you have all the tools to make an informed decision with your own brain. So use your brain. It will help you. Next winning decision, selling Evo. The most amount of views I get out of this channel is from Evo. Evolution AB has been a very interesting stock to follow, an interesting company to follow. And I bought in 2023 because I expected the company to reaccelerate. I expected the company to have temporary problems and then you go back up. It turns out the problems are not temporary. So I bought in December 2023, around here. The stock went up and then down. I doubled down. Down again, I tripled down. And then at the beginning of this year, they had a horrifying quarter and I sold everything. It was 10-12% of my portfolio. At the beginning, I think it was my biggest position at some point, like 15% of my portfolio, but the stock is going down. So 15, 14, 13, 12, 11, 10% of my portfolio. And with this bad quarter in Q1 2025, I lost all conviction and I said, I'm out. Because all the problems that I thought were temporary turned out to be not temporary. So I lost the conviction. The time frame, how soon can you see a reversal? And in this quarter, they said, we don't know. We don't know when the reversal will come. So I said, okay, if you don't know, I don't know, I'm out. Let me invest in other opportunities that have more visibility. Because if the management has no clue and the management is not helpful to shareholders, and if the management is just accumulating problems and problems and problems, come on, I don't want to be invested in tricky situations. I want to sleep well at night. So I bought because I thought it was a turnaround play because problems were temporary. It turns out it was not temporary. Okay. And just after I sold, I remember vividly, during the summer, the stock went up and then people started to hope again. And you had Q2 and Q3 and back down. And now we are reaching the all-time lows. Lost money, dead money, for all the people that just held Evolution. I'm still bearish on Evolution. I hope for them the best. The industry is growing. The online gambling industry is growing. But when will they go back to growth? Nobody knows. And people don't know much accounting for Evolution AB. People are, hoping for the best when in front of you you have somebody that is lying. So people expect too much of Evolution right now. It's a long-term play, it's a long-term hold, but when will they turn back to being growing again? Nobody knows. It can take 6 months, 1 year, 2 years, 3 years. When will Asia come back to growth? When will Europe come back to growth? If you ask the management team, they said, we don't know. Do whatever you want with this information. But it has turned from a growth play to a value play to now a turnaround play. And I don't like this. Now, some people say it's too cheap to ignore. The stock price is too cheap. You have a PE ratio of 10, a dividend yield of 5%, and a buyback yield of 4 or 5%. Yeah. Okay, fair enough. You can make 5%. That's a 10% yield for a business that has no visibility and you have some potential re-rating in the future. I understand why people are buying the dip. It's just not my style. I have followed the Evolution for too long to just hold and hold and hold. And the management is not shareholder friendly. In terms of communication, I don't like. So I just find better. It's okay. If the stock rebounds from here, so be it. But I'm very happy I sold I sold, and I don't want to get back in right now. So I sold in May, and it was a winning decision because with these proceeds, I bought other stocks that went up. So for 2025, it is not a mistake. It is a win. Let me continue with another one. Speaking of winning decisions, selling KNSL. Well, I'm talking about all the sales now. Kinsale Capital is a company in the excess and surplus segment. It's an insurance company. And I bought this company in summer 2024. And I sold, I don't know, it's September 2025, something like this. I make a quick gain out of this because I started to see some signs of deceleration in this business. The business is going fine. You have some good insiders, good management teams, but I'm seeing some signs of deceleration. And I just talked about a growth trap that Pool Corp was. Well, maybe I started to see some signs of deceleration for Kinsale. For the moment, the signs are not very bad. It's just some tipping points. And again, I sold Kinsale to buy other things that I have more conviction in. So I'm very happy I sold. And on a year-to-date performance, I sold around here, I think, when the stock was flat. And it has gone down and down and down and down and down since then. So far, so good. So far, it's been a win. We will see in the future if it continues to do nothing or if it comes back to growth again. But it's a business that is known to grow double digits. And now all the premiums, all the revenues, or everything is decelerating. And when you have a business like this that is known for growing a lot, and suddenly for a few quarters, 4, 5, 6 quarters, they don't grow a lot anymore, you have to ask this question. Do you know how long it will take for management to pivot? Do you know what are the reasons of the deceleration? And do you have a lot of conviction? If for one of these 3 questions, your answer is no, I don't know, maybe this is not something you want to hold. And this was my reasoning for selling Kinsale. Next one, selling TPL. At the end of 2024, I'm including this for my 2025 recap because now we know if it was a good decision or not. I sold TPL in November 2024. And I made a video about this. You can check. You can go back to my channel. You can type on the search bar TPL and you will find many videos. I sold the TPL at the absolute top, like $1,650, I think, like this. Absolute top on a weekly basis. And my reasoning was valuation concerns. The stock is great. It's maybe my favorite stock of all time. But the stock is just trading at too high a price. And it was recently included inside the S&P 500. I said it was some good exit liquidity. The stock went up 17% in one day. And I didn't like this at all. So you had a parabolic move and I sold at the top. Guess what? Since then, for the remaining part of 2024 and for 2025, the stock went down and down and down and down. And every time I saw people that were looking at the drawdown percentage. If you go to TPL on Fiscal AI, you click on drawdown. This is what you have. Now the stock is in a 50% drawdown. This is a great tool, by the way. And if you want to use Fiscal AI, you can use my link in the description to get it 15% cheaper. It's a great website that I use on a daily basis. You can just use Fiscal AI. It's maybe the best. And click the affiliate link in the description to get it cheaper. People start to freak out for TPL, by the way. They look at the stock price and they say, it's down a lot. Yeah, it's down a lot from a very high point. So it's normal. They say it's a very large drawdown. Yeah, but we've never had this kind of valuation. For TPL, if you look at the simple P/E ratio, you have 2021 and now. Look at this, 2021 and now when I sold. November 2024. PE ratio of 80. It was such a ludicrous valuation. And at the time, people were not fully agreeing that TPL was expensive because of potential data center plays. Because TPL has become a data center play, they will welcome data centers because you have to value TPL based on their lens because you have no. Literally, you just take the earnings, you look at the PE ratio. You look at the PE ratio and you just sell when it's high. So the process, my investment process is very simple. The goal with my videos is to teach you how simple investing can be. A PE ratio of 80, even if that's my favorite stock of all time, I just sell. And now the PE ratio is 43. Still too expensive. And I'm waiting. And it has been a very, very good decision to sell at the absolute top. Now, let's talk about the holdings. What I held throughout the years before all of this drama of AI and after this drama of AI. A couple of months ago, Google was hated because Google was losing. ChatGPT was winning. And in April, in May, Google was down and insulted in the market. And the decision to hold Google was maybe my biggest win of all 2025. Because now, if you check my portfolio, my public portfolio, my portfolio is public, you can go on the description to check it. Google has become such a big winner, it is now my largest position with 15% allocation. So it has generated a big amount of my outperformance this year. Holding Google has been the good decision because the management has become hungry for more, which was not the case 1 year ago. If you look at the history of their AI involvements, and Bard and their woke images. If you ask your Bard, it was not called Gemini at the time, it was called Bard. Can you send me 5 pictures of the Pope? Every time it was a black female. You ask Bard, can you generate an image of Vikings, black females? I mean, okay, fair enough. So completely crazy image generation from Bard at the time, and now it seems like everything is working okay. All the LLMs are working fine, so Google is winning. Now you have Gemini, Flash 3 Plus, Ultra. They are just upgrading their business model, updating more press releases, more good news, and the stock has rebounded immensely, and now the stock is at an all-time high. So obviously I'm happy with holding Google. It's a winner and everything has accelerated. Next point, holding Lam Research, and I would say doubling down. I bought Lam Research, I think in late 2024, and I held, and during the crash of April, the stock went down immensely. And I have an average price of $80 for this one. So I think I bought just before the crash of April this year. And the stock price has gone down a lot and then rebounded a lot. If you look at the year-to-date performance for Lam Research, which is a cheap equipment company, on a year-to-date performance, we are up plus 130%. And now I'm starting to trim because the valuation has gotten a little bit rich. I reduced the position by 50%. I did not sell everything, but I reduced the exposure. Fair enough. I'm just being investing with the, how do you say it? Money on a house money. I mean, I make a double and I cut by half. So now I'm just playing with all the gains and being invested. It's still a hold. It's still a quality compounder. It's still asset light, which fits my framework. Very high margins, very shareholder friendly. They do buybacks, they do dividends. It's very efficient. It's in a growing industry. They will benefit a lot from AI. You have a lot of demand for what they sell. And I bought at a reasonable price, PE ratio of 20. Now the PE ratio is 35, 40. So a little bit expensive, but not so expensive like TPL with a PE ratio of 80. So this is the reason I'm not selling completely out of Lam Research. But holding Lam Research, despite all this drama, this DeepSeek drama, this tariff drama, because they have a lot of exposure to China, has been a winning decision. Okay? You hold into good companies because winners keep on winning. Next point. Oh, this is it. These were all the winning decisions. Lessons. Winners keep on winning. When it comes to Lam Research, it's a good example. When it comes to Google, it's a good example. Second lesson, losers keep on losing. If you have problems and you don't have visibility, problems can keep accumulating. And the 2 points, winners keep on winning and losers keep on losing, mean you want to avoid turnaround plays. Most of the time, turnaround plays don't turn around. If you have a great business and suddenly they have so many problems at the same time, it would be very hard to turn the ship around. You have only a handful of CEOs that can turn the ship around. And yes, I'm talking about Mark Zuckerberg and Meta Platforms. Only a handful of CEOs that can make massive decisions to have a turnaround play. Evolution is not like Meta Platforms. So, next point, next lessons. Extreme valuations are not sustainable. For TPL, we reached an extreme valuation, P/E ratio of 80, 88. Extreme valuation, they are never sustainable. One day or another, valuations will drop. The same thing is true for Fair Isaac, FICO. Valuations don't go to the sky. Next lesson for this year. Valuation is expensive if earnings go down. This is an example with Pool Corp. I told you Pool Corp, they were trading at a reasonable valuation, a little bit of a premium, but net income went down. The net income went down, so the P/E ratio went up. So even though the stock price dropped a lot, the P/E ratio did not drop a lot because the net income dropped. The revenue dropped, the free cash flow dropped. So you only want to look at the P/E ratio for companies with net income that are stable or growing. If you have a decreasing net income, looking at the P/E ratio can be a mistake. Okay. I bought in, I think 2021, I don't remember very well. Maybe a year at a P/E ratio of 30. And now, despite the stock dropping 60%, I mean, if you drop 60%, the P/E ratio should have gone from 30 to less than 15, more than cut in half. No, the P/E ratio is still 21. So P/E ratios mean nothing if the net income is decreasing. Okay, valuation is expensive if earnings go down. Another lesson from this year that I think you know too well is AI sentiment is changing fast. Google is the perfect example of this. People insulted Google and now people are praising Google. The same thing can be true for all the AI players. The same thing can be true for all the analytics companies. FactSet, or maybe ADP, or maybe Accenture, or maybe Adobe, or maybe MSCI, all the companies that are potentially being disrupted by AI, like Salesforce. Guess what? If these businesses reaccelerate, people will forget. People will change their mind. Their conviction is so weak. People have very low conviction, very weak conviction. It's very easy to change your mind in 6 months, and people don't believe in companies. And that's okay. This is the reason why we can outperform the market, because people are weak. So if people don't have conviction, don't hold strong convictions, they will sell. And if they sell disregarding of the price, if they sell regardless of the price, we can buy. And Google is a perfect example of this. People were selling Google again and again and again and again. Google was extremely cheap. If you just hold, believe in Google, this is fine. So winners keep on winning. This is a very good point, and the reason why my framework has changed this year to only invest with high quality companies and avoid value plays. I only want to be invested in winning companies. Now, my new portfolio to outperform the market in 2026. You have a few companies that I have bought this year. I believe this fits my new mold, my new framework for investing in superior quality companies, superior management team companies, everything that is going in the right direction, all the green flags that are possible. You have MasterCard and MSCI, asset light, no capex, buybacks, toll bridge model. You have Fortinet. I'm buying the structural growth of AI-driven threats. It's a great company that I have been following for 5 or 6 years now, and I'm a happy shareholder of Fortinet. Next buy is Adobe, the most recent buy for a re-rating and a business that refuses to decline. 3, 4 companies that were recently added to my portfolio. Very high margins, a lot of efficiency, a lot of buybacks. You see the same pattern happen over and over again for all my latest buys. So you see the direction I'm going to. Now some updates about 2025 and my coaching program. This year, the program improved a lot. More and more people joining the community. Only serious people that want to improve their portfolio and their performance. The coaching program is doing well. People are happy. We have calls every week. We are analyzing companies together. And as you can see from some testimonials I have shared on YouTube, people have a before and an after joining. Before, the portfolio was messy. They didn't have a structure. And after, now they know exactly how to analyze companies. They know exactly how to build a strong portfolio, and they know exactly how to improve their performance. Okay? My clients don't come to me for the next hot stock. They come to build a framework to filter the market and only invest in the top 1% of companies. As you can see here from all my latest buys, I only buy high quality companies, and I'm teaching my clients exactly how to do this, how to have a framework to only invest in the best companies, because the best companies will outperform the market. So you want to fill your portfolio with winners. Winners that will keep on winning. This has been the best lesson of 2025. So if you only invest in the top 1% of companies, this is how your performance will improve. And if you want to work with me directly, you can click the first link in the description. You will have my website and you can book a call with me so we can have a chat, a friendly chat, and we can discuss to see if I can help you to only find the top 1% of companies so that you can finally beat the market, outperform the market, and have the performance you deserve. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a video, a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.